Good morning, everyone. This is Barry Knapp from Ironsides Macroeconomics. It's Monday morning, June 7th. Our note this week was titled Future Shock. It was released on Saturday the 5th. First things first, I'm wearing my U.S. national soccer team jacket this morning in celebration of the U.S.'s CONCACAF Nations League victory over Mexico last night. Those of you on the East Coast may very well have not stayed up for this. It was on quite late. It was in Denver at Mile High. I'm not sure why I didn't go down and see it. I certainly should have done so, but it was a brilliant match. U.S. won on a late penalty from Christian Pulisic, and the match was saved by Ethan Horvath, the backup keeper who came in late due to an injury to Zach Steffens, who plays for Man City, and made a brilliant save in the dying minutes to preserve the victory for the U.S. 3-2, great match, good win for the young U.S. side. This is the best U.S. side we've ever had, in my view, even perhaps the 2010 team led by Landon Donovan. So that's it on soccer, I promise. One quick note before I move on to discuss this week's report. We released a special report last week. We did not do a podcast associated with it, but we'd love you to all take a look at it. It's on our website, ironsidesmacro.substack.com. It's titled Disinflation, Reflation, and Inflation, 60s Deja Vu All Over Again. It really does detail the last time we had both expansive fiscal and monetary policy, what it meant for the economy, what it meant for the markets. It was a bad period for the bond market, a good period for the stock market, initially, at least, until we moved from that reflation into inflation regime. And it had pretty significant global exchange rate system implications as well. And that's a lot of what this report is about. It's been published a couple of places by our friend Jared Dillian, who writes the Daily Dirt Nap, as well as John Malden's Economics picked it up as well. So please have a look at that note. On to this week's note, there were three sections. The first one was Future Shock, which was reopening disruption and what it meant for the markets. We're going through another one of those periods. The second one was on labor market bottlenecks. Of course, this is our review of last week's labor market data, culminating in Friday's monthly payroll report. And then a section called Corrections, Crashes, and Bear Markets. So first on Future Shock, we thought early on in the pandemic that what the pandemic was likely to do was to accelerate a trend we were already writing about pre-pandemic, which was an acceleration in technology innovation adoption in the delivery of goods and services to the consumer, but throughout the broader economy. This was going to increase potential earnings growth. It was already boosting productivity in 2018 and 2019. We now see earnings expectations having blown through the pre-pandemic baseline. And so this is net on balance going to be a positive productivity shock that increases potential earnings growth of the S&P. But we do hit these points when the economy is reopening, when the market starts to struggle with the changes in trends or leadership. So we had it with the meme stocks back in the late January, and we described that as typical of the early stages of a recovery where low quality, the stuff that was hurt worse during the recession, starts to rally the hardest. It happened again last week. You saw Zoom report fantastic numbers. We cited a paper by one of our favorite economists, Stephen Davis, where there truly is going to be a big increase in total workdays done from home post-pandemic. So this is good news, long-term news for those type of companies. But the big rally last week was in AMC, which is clearly a reopening stock. You could also see this in the market, which is domestically focused PMI surveys, more so than the ISM surveys, where the service sector PMI is up to 70 and manufacturing is in the low 60s. So again, this is one of those reopening disruption points that caused a little bit of consternation in the market, but we never really went down. And in fact, we're right up at the highs. So we think that was the thesis that was running through the markets, and we think that's more important perspective for how to think about these meme stocks or the parabolic rally we had in AMC than trying to associate it with a major top like the 1990s, which we'll come back to in a few. The final point here is that we continue to believe that the next big trend in the markets, the next big surge, will be another reflation rally, and that'll be when the Biden administration and Democratic Party decides to go its own way and use reconciliation to do another big tranche of deficit financed government spending. So that's coming in within the next week or two, we would expect. So onto the labor market. It's pretty clear there's significant labor market bottlenecks. The bottom line on Friday's report is that the leadership of the Fed is going to feel justified in current policies and is not going to want to move forward. We've said we need 2 very strong payroll reports to get them to consider tapering the asset purchases. We didn't quite get there on Friday. 559,000 was a decent headline, but they're looking for that 7 million or so of job losses from the pandemic to start to come back. Our perspective, as you know, is that the labor market is much tighter than that 7 million job loss narrative would imply. And you could see that in the labor force participation rate for prime age females, which fell for the second month in a row. It fell from 75.2%, which was around last cycle's average, back to 74.8%. The unemployment rate for females aged 25 and up fell 0.3% to 4.6%. This is not happening necessarily because they're getting more jobs. This is happening because women are at this point not even looking for them, dropping out of the labor force. So this is not very good news. We could probably point straight to teachers' unions as a bit of a culprit on this. Certainly the expanded and extended unemployment insurance has a role to play here. And so there's a lot of policy stuff that's creating bottlenecks, but it's boosting wages. And some people may view that as positive, and of course it is. And nominal wage growth is a good thing, but when it gets really rapid, that's when you have a risk of inflationary expectations bleeding into the psyche of the population. Certainly, I know, and just anecdotal discussions I have with people, that's what they want to talk about is inflation. Average hourly earnings increased 0.5%. In May, they were expected to increase only 0.2. That follows up a 0.7 increase in April. We've got a real acceleration going on. We anxiously await the Atlanta Fed wage tracker number in another week or two, where they do a very good job dealing with mix shift, and we think we're going to see a lot more upward pressure there. So again, the bottlenecks in the labor market will eventually clear, but it's going to take some time. 25 states have pulled out of those expanded unemployment benefits, but those are not the states that were the last ones to reopen. Those states will not pull out early. So on the coasts, we're still going to have labor market bottlenecks. Maybe it will start to clear in the middle of the country a little bit, but I can tell you it's pretty acute up here in Colorado. So final section of the report this week was titled Corrections, Crashes, and Bear Markets. This was prompted by some of the comparisons we think are spurious to the meme stock rally and the late 90s speculative fervor amidst the TMT investment boom and bust. So, within our note, we have, again, our analysis of business cycles and how bear markets for us are not defined by the percentage decline in the stock market. They are associated with recessions. We've had 12 post-war recessions. They last 11 months. The stock market goes down 30% on average and bottoms some 89 days before the end of the recession. That's a bear market. There is generally a malinvestment bust associated with it. Consider the 90s. We had 10% increases in non-residential investment per annum for a decade. And some of that was overinvestment, and it took years to work off that malinvestment bust. The government response to it was to try and spur investment again. That led directly to the housing boom and bust. Again, a malinvestment bust. That's a bear market. That's what happens in a bear market. A crash can happen, and 1987 and 2019 are the best examples of this. In both those cases, we had huge declines in oil prices. The stock market went into a range during those declines, 85, 86, and 2014, mid 2014 through early 2016, when the stock market or when the oil price stabilized, the stock market took off, went up 50+% in both cases, went to 20 times earnings. The market was vulnerable. We had a Fed, in both cases, a new Fed chair tightening policy fairly aggressively, Greenspan and then Powell. We had a tax reform bill that caused 20+% declines in new home sales and housing starts. The Tax Reform Act of '86 reduced the incentive for mortgage interest because of lowering that top marginal tax rate. The Tax Cuts and Jobs Act, of course, eliminated the SALT deduction and raised the standard deduction for lower income or lower end housing purchases. Very similar declines in the housing market. And we had trade wars going on in both cases. People forget in the mid 80s, Reagan put a 100% tariff on Japanese semiconductors. We'd had the Plaza Accord, but still the Germans and Japanese were very reluctant to allow their currencies to appreciate. Trade war, just like the Trump trade war, and that macroeconomic stability caused a crash, but there was no knock-on economic effects. There was no malinvestment bust. We don't have those conditions in place today, either that level of macroeconomic instability, though in our 60s analog report, we believe we will get there, but we don't in 2021. And so having a crash is highly unlikely. Corrections are a whole different story. We've written a lot about, and most recently we wrote about this at length in a report called Das Kapital. We wrote about what triggers corrections early in the business cycle. And it's generally the Fed pulling back on monetary policy, trying to normalize policy. Every business cycle since World War II had one of these. Last cycle had 8 because of the extraordinary unconventional policy. We think we will likely get one of these sometime in the third quarter when the Fed does start talking about tapering asset purchases. But between now and then, our framework this year has been we can get sentiment-based 4 to 6% pullbacks. We can get 4 to 6% pullbacks based on reopening-related disruptions, ebbs and flows in the data. But to get a correction, we need either fiscal or monetary policy tightening. That's likely in the third quarter. But for now, we actually think the next move is likely to be higher. It'll be a reflation-related rally when the Biden administration goes their own way and decides to do another 1 to 2 trillion in deficit financed government spending. So that's it for me this week. Thanks to Nucleus 195 for putting this video together. We'd love you to be a subscriber to our YouTube channel. We could use a few more subscribers there. Please subscribe to our podcast, and by all means, consider becoming a full paid subscriber to our research. That's where all the tables, notes, specific investment ideas, and all are that back up this podcast. So Barry Knapp, have a good week, everyone. And this is a good young U.S. team. We begin qualification for the World Cup in a couple of months' time. Be sure and watch us. I think we'll be really good at the next World Cup. Barry Knapp, Ironsides Macro. Thank you.